Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. And today we're going to go over Jerome Powell's recent speech. And I'm here with none other than our great friend, Scott Walters. Sir, how are you?
I am good. Thank you so much, Travis. Always an honor and a privilege to be with you. And more importantly, the audience today. I hope everybody's doing great.
And I appreciate you taking your time to be here with us, man. Now, obviously, Jerome Powell put out a recent speech. A lot of people are thinking, it's time to get back into the market. So we'll explore that today. And, just real quick for our viewers, do us a favor, guys. Go, and like this video, subscribe if you haven't already. And then after that, go to Scott's page. And I'm going to bring that up real quick, Scott. It's right here. It's the Scott Walters Report. Scott is one of my favorite YouTubers of all time. I love Scott. Scott was there, with me from the beginning, helping me. We now have a group together. I absolutely love him. He's sounding the alarm. He's basically trying to educate people to be cautious. So go over to the Scott Walters Report, you guys. Subscribe to it. Hit notifications. And Mr. Walters, sir, before we begin, and I have the video here we're going to go over. Do you have anything to say before we start?
Well, of course, it's just an honor and a privilege, like you said, to ring the bell, sound the alarm, read between the lines, and look between the cracks of, the biggest real estate bubble ever produced in history. And I was just fortunate enough to come very early on and start ringing that bell. Of course, there's been a great divide through this whole crisis. It was just so much division from a political and economic level. So I think there continues to be a divide, but unfortunately, as much as I'd love to see the real estate market be able to sustain itself, it has in fact reversed course. And I benefit from this euphoria continuing because I'm licensed to buy and sell real estate. And while it's been very lucrative, even within and even now in a declining market, for me, it's just been really interesting to see the dynamic. This is a very interesting dynamic that we found ourselves within. So when I see industry professionals very closed off to the potential or possibility that this market, this housing bubble is at risk and can potentially pop, that really rubbed me the wrong way. And I get it during the Kool-Aid drinking, the euphoria. So many people out there saying how this time was different, that there's no crash risk here. Anytime that the market exhibits bubble behavior, you have to admit at least there's a chance that it would crash. So when I saw people not even just so closed off to the potential of a bubble being able to pop, it alarmed me to the point where I came to YouTube and started reporting on this very serious, crazy serious matter that if we lose the U.S. housing market, we will lose our economy. There's one thing that can collapse this economy quicker than anything else, and it's the U.S. housing market. So it's a great temperature check and heat map to see the health, the fitness of the U.S. housing market. And the realities are, Travis, through the crisis, we put it through the biggest stress test ever witnessed in history by restricting supply with lockdowns and then increasing demand with interest rates being dropped and making real estate agents essential workers. You're essential now, Scott. You can go sell. We're all at home. Essential. I thought, what, groceries, things, essentials, not me. And next thing you know, the phone started ringing off the hook and the money started pouring in. And of course, anybody that has a vested interest in this, real estate professionals, of course, they wanted to believe that this could last forever, ever. But it, in fact, has reversed course. So now the $1 million question: if it's going to crash, when? And that's kind of where we're at now. It's no longer if. It's kind of when.
In my opinion, Scott, and you covered a lot of ground just then, man. And the video that we're going to watch, actually, Jerome Powell is going to essentially agree with you. The housing services is really important. So we'll get to the video, but I absolutely agree with what you're saying. And that's why it's important to stay forward thinking as well, because it's really, yes, professionals are starting to finally come around and kind of understand the data. But I agree with you, man. When I first started hearing this, and I'm like, how could, a lot of professionals, how could you be blind to the data? How could you be blind to the trend? And I understand there's like wordplay, like correction versus crash, and there's that whole narrative. But I really appreciate you stepping up, Scott. A lot of people, didn't do that because, like you, I'm in sales. So you and I make money when the house, we make decent money when the housing market is doing well. When it's not doing well, and when we're telling our own customers don't buy, that hurts us financially, morally, and life and karma and being able to, those things are great. So love you, brother. Let's get started real quick. I'm going to try to pull this up. Now, I hope my audio is okay. We're going to listen to a little bit of this, Scott, and I want to get your comments and thoughts on this. This is Jerome Powell. This was on Wednesday, the end of November, and he's going to go into inflation, and I really want to kind of get to where he starts going into the housing sector, because I think it's important that people understand what's coming. So let me make sure you can.
At
Can you hear it?
6.0%.
Yeah, you're good to go. Let's hear
While
what
the
he has to
October
say.
inflation data received so far showed a welcome surprise to the downside, these are a single month's data, which followed upside surprises over the previous 2 months. As Figure 1 makes clear, down months in the data have often been followed by renewed increases. It will take substantially more evidence to give comfort that inflation is actually declining, and by any standard, inflation remains far too high.
So I'm going to fast forward. I mean, essentially right there, he's, by anyone's standard, inflation is way too high. We've only had essentially 1 month of report. I'm going to fast forward to the 130 mark and then get your comments.
When will inflation come down? I could answer this question by pointing to the inflation forecasts of private forecasters or of FOMC participants, which broadly show a significant decline over the next year. But forecasts have been predicting just such a decline for more than a year, while inflation has moved stubbornly sideways. The truth is that the path ahead for inflation remains highly uncertain.
All right, so I'm going to pause there, Scott. So, he's off. I mean, what do we believe? I mean, how many times have they been wrong? But I mean, he's acknowledging that at least the path is uncertain. We only have 1 month of good data. It's still, the inflation's unprecedented. Can I get your thoughts on that segment of that video?
Yeah, absolutely. So what I see, guys, is Jerome Powell. He is, he's found himself in this unique position. And, part of the markets, they're going to behave the way they're going to behave. But he has the ability to move these markets with his words. The stock market in specific hinges on every word out of his mouth and trades along with it. And he knows this. He's very aware of this. His handlers are very aware of this. So he's got to be very picky and choosy on how he uses his words, because the wrong word out of his mouth will crash the stock market in seconds. That's how big what he says is for the stock market. Now, a lot of the other markets trade along with the stock market, except real estate moves much slower. Of course, it's a lagging indicator. But what I'm hearing from him personally, as I read between the lines and look between the cracks, Travis, in our audience, is he's starting to prepare us for what's coming. He is not sprinkling rainbows and sunshine here, is he?
I mean, Scott, I didn't want to be biased, so I don't want to set you up, but sometimes I think I'm crazy, because that's, to me, what he's clearly saying. So I don't understand these market rallies. I still don't get the over optimism. I understand that inflation may have peaked. That's good. There's less dust in the air. We can all better understand, including you and I, who have special insights. So, I think the stock market is foolish, and I don't know who's pricing in stuff, man. But I think he's preparing us, and I think it's clear to some of us that he's preparing us for what's to come. But if I can, let's move on to the next part of this video, which essentially is going into what you're saying. I'm going to play this right now, brother. I think you're definitely on point. Let's go right now. This is about 1 minute, a little over a minute long segment right here. You ready to go?
Let's do it.
For now, let's put aside the forecasts and look instead to the macroeconomic conditions we think we need to see to bring inflation down to 2% over time. For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There's considerable uncertainty about what rate will be sufficient, although there's no doubt that we've made substantial progress, raising our target range for the federal funds rate by 375 basis points since March. As our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting and the summary of economic projections. I will return to policy at the end of my comments, but for now, I'll simply say that we have more ground to cover. We're tightening the stance of policy in order to slow growth in aggregate demand. Slowing demand growth should allow supply to catch up with demand and restore the balance that will yield stable prices over time. Restoring that balance is likely to require a sustained period of below-trend growth.
Okay, so to me, a sustained period of under-trend growth, more ground to cover, that he expect interest rates, Scott, to be higher than September. So to me, it's sounding like maybe it'll be slower, right? I mean, 50 basis, is 50 basis, when do 50 basis point rate hikes become slower? But can you give your thoughts on that, Scott, on what he's saying, what that means to what's going to happen next?
Yeah, so based on my experience, the only way to get inflation under control is to raise the federal funds rate to the rate of inflation. And we're not there yet. So he's saying we got a little more room to go. Of course, they can't just raise it there automatically, on one fell swoop, or it would just be a really swift and fast shock to the markets. It would crash them. So it's a delicate dance. We're on that razor's edge trying to do these little small interest rate hikes to get ourselves to the federal funds rate to the rate of inflation, and then let the markets react and hope that inflation comes down. Now, that's the $1 million question. Will it work this time? Will that method work? That's yet to be seen. A lot of economists, and myself included, believe that we're quite at risk now of not only, we're not only going to be in a recession, but inflation is going to stick around. And that would be catastrophic, right? So, that's what I'm seeing here out of the federal government. Historically, the only way to get inflation under control, raise the federal funds rate to the rate of inflation. We're getting close to that now. Maybe once we get there, we kind of catch our breath, see if we can get inflation numbers to start coming down. If not, we're in big trouble. Now, for me personally, side note, I think that if you put like a percentage of likelihood if it's going to work, it's 50-50 for me. Maybe it does. Maybe it doesn't. I think that you can't bank on it working, Travis. I just think that we've done too much damage to the economy. We've flooded too much money into the economy. There's not enough jobs and manufacturing left in the U.S. to really do what worked in the past with this method today. There's so many components to take into consideration here. The realities are already, what are we seeing? We're seeing job layoffs run rampant in the white collar industry. And who buys homes? White collar wage earners. Blue collar jobs are available right now, but who rents homes? Blue collar wage earners, historically, not as a whole, but historically. So what we're going to see is a lot of people that bought into the height of the crisis with their white collar incomes, dual incomes in most cases. One loses their job, they now have a hardship. To even get a loan modification, you have to show that you have the ability to pay. If inflation is now robbing you of your cost of living and that one income can't do both, you no longer qualify. So my position is currently that by this time next year is when we're going to see exactly if this works or not. And if it's not a matter of if foreclosures will come or not, they will. It's going to be at what levels will it be? At basically epidemic levels, another foreclosure crisis. You can't rule that out. And I have a hard time watching any industry professional say that there's no chance that will happen. There's always a chance. And if there was ever a chance, we are living in it at the moment. The perfect storm is there to deliver it. Nobody can guarantee it. If I was a betting man, which I'm not, I would say it's a 50-50 chance by this time next year, if not quicker. It could be a flash crash. We're already seeing these markets get devastated overnight. I mean, the markets are moved by one billionaire, tweeting something, much less Jerome Powell coming out and giving an announcement like that. But he's sugarcoating it. He's trying not to shock the markets. We're getting that interest rate, federal funds rates up to the rate of inflation. Once that's been achieved, then we might stop and see what the market does. But we got a lot of work left to do, in my opinion, brother.
And hey, man, I really love the genius, Scott. I mean, you brought out what I think is going to be a really, really, really important thing moving forward, which is unemployment. And the reason I think that is like the Fed is combating a labor market that we pay to be immune to COVID lockdowns. You know what I mean? Our labor market has so much money in it. It was small businesses and businesses are supposed to survive through COVID. So in order for us to get the feds to get unemployment up, imagine the braking that has to happen for it to hit that level, and that's what I'm wondering, like what has to break, right? And how much is going to break that's unrepairable for us to get the unemployment. And quite frankly, that's why, that's why I say, I believe there's going to be a bit of, overcorrecting. And I think the flash crash is definitely possible. And unfortunately, I think as a result of that, Scott, it's possible more money printing. I hope not, but it is possible. Let me take us to the last part of the video, brother. I'm going to get us brilliant answers, man. I love how you just got right to, I mean, we're looking at unemployment, because we understand in order to get there, it's going to take a catastrophe, So here's where we're going to go into inflation. And essentially he goes into, there's like three things of inflation he's looking at, but I'm going to focus on the housing services because that's kind of what a little bit more pertains to us. As you said earlier, obviously the housing market is like everything almost with the economy. And if we lose the housing market, we lose so much. And I'm thinking the unemployment may lose us the housing market. But I'm going to focus on that, brother. You ready to go?
Yes, sir. Yes, sir.
And this segment is about 45 seconds long, and then I'm going to skip ahead to housing.
Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it's useful to break core inflation into three component categories: core goods inflation, housing services inflation, and inflation in core services other than housing. Core goods inflation has moved down from very high levels over the course of 2022, while housing services inflation has risen rapidly. Inflation in core services ex housing has fluctuated, but shown no clear trend. And I'll discuss each of these items in turn.
Okay, so I'm going to skip the first and last one and just go straight to housing services, which he's essentially saying have increased rapidly, right? The really important like housing market, and he's he's destroying the labor market. Like, geez, do you want a Great Depression, brother? I mean, I guess the question is, do we need it? Let me fast forward to the housing services. I apologize. It's right here. And this segment, Scott, is about a little over a minute long.
Cool.
Housing services inflation measures the rise in the price of all rents and the rise in the rental equivalent cost of owner-occupied housing. Unlike goods inflation, housing services inflation has continued to rise and now stands at 7.1% over the past 12 months. Housing inflation tends to lag other prices around inflation turning points, however, because of the slow rate at which the stock of rental leases turns over. The market rate on new leases is a timelier indicator of where overall housing will go over the next year or so. Measures of 12-month inflation in new leases rose to nearly 20% during the pandemic, but have been falling sharply since about mid-year. As Figure 3 shows, however, overall housing services inflation has continued to rise as existing leases turn over and jump in price to catch up with the higher level of rents for new leases. And this is likely to continue well into next year. But as long as new lease inflation keeps falling, we would expect housing services inflation to begin falling sometime next year. Indeed, a decline in this kind of inflation underlies most forecasts of declining inflation.
Okay, so he needs the rental market to take a hit. I'm not sure if that's what you're getting as well. So not only are we getting hit with the prices, interest rates, unaffordability, he's attacking labor market. He's attacking the rental market, which I'm not saying is bad, but there's a lot going on here. Scott, would you unpack it for us?
Yeah, I mean, so like we talked about early on, is what I see is Jerome Powell's choosing his words very carefully. He's got handlers that they go over how he's going to communicate this message without shocking the markets. As we read between the lines and look between the cracks, what I'm hearing out of Jerome Powell is like we talked about, if I'm correct. So they're seeing some decline in inflation in certain areas, but housing isn't quite there yet. It's lagging behind. That's to be expected. Now the question is he's saying we need to get that there. And we heard one of his earlier speeches when he was addressing inflation and housingly specific that we needed a bit of a reset in the housing. So I know a lot of people are saying, and I think you blew the lid off of Realtor.com trying to in fact say this. A lot of people, and especially real estate companies, who all their stocks are in the tank, by the way. So that's a pretty good indicator of what the housing market's doing. They want to say that, see, Jerome Powell's not going to be happy with a flatlining housing market. He said we needed what? A reset. He said we need prices to come down. So a lot of people like Realtor.com, maybe, they say we're going to get back to normal appreciation, maybe a tick or two up, still, 4% appreciation rates. That's not Jerome Powell's mission. His mission is to give the housing market a reset. If you've been waiting, you might want to wait a little longer. And whether he wants to or not, like we talked about before, the percentage of likelihood, let's just stay as neutral as we can at 50-50. There's a 50-50 chance. I think it's more than that. That there's the housing market for one. I always come back to, you can throw the data out, throw the playbook out the window. The data won't save you. It'll come down to the psychology of people, like we've talked about, higher confidence. And so, but for me, it comes down to very simple mathematics and historical trends. Every single time, not 1%, not 2%, 100% of the time, the housing market has exhibited bubble behavior. They've crashed. I'm not saying corrected. I'm saying crash. So I think 50-50 is a very liberal position to be in this moment. But what I hear from Jerome, he's doing his best to sugarcoat it and not shock the markets, but communicate in his way that we need to slow. Housing isn't showing it yet, and he needs to tackle that. Now, federal funds rate will eventually get to the rate of inflation or very close. And if it starts to do its job, we might stop, but it's not going to fix the housing market. We need about a year, I believe you said, to see those numbers and the blowback and the turnover in leases and tenant turnover and people that lost their jobs. Can they in fact modify loans? Are they going to have to, just do short sales and foreclosures? They're coming. They're coming. They have to come. Anytime job losses occur, foreclosures occur along with it. It now becomes, as we monitor this thing moving forward, at what levels can we keep the reins on it enough from turning into a crisis? Correction, recession, depression. Those are our three levels of an economic downturn. Right now, we're in the correction phase, the front end, tail end of a health crisis, front end of a correction. And we're seeing the devastation it's already showing in many sectors. Housing market will join the party. It'll be a miracle if it doesn't. I hope it doesn't, Travis. I want to go sell houses and become, I didn't get rich selling houses. So I'm lucky that I can run my mouth the way but like you said, this is putting people's needs before your own. And it's rare you're going to get that out of an industry professional. Very, very rare. I know, because I work within this community every single day.
Well,
but that's it, my friend.
Man, dude, I can't tell you how much I appreciate you and your insights. We don't always agree on every single detail, but I don't understand how people aren't understanding what he's saying. Now, obviously, there's no crystal ball. We'll keep watching the data. We'll keep trying to bring the crystal ball out. But to me, the path is clear. There's going to be more pain. The home prices are still unaffordable. I mean, it's still out of so many people's reach, Scott. But I really appreciate you, brother. We've been talking for about 24 minutes, man. I'm gonna let you go. Before I do, man, anything you want to say? Any final words?
Oh, absolutely. And final thoughts, friends. It just comes down to basic mathematics. The biggest housing bubble ever produced in history, artificially created with no organic growth, has some crash risk on it. Please stay Stay tuned. Do your best to acknowledge the elephant in the room that I just spoke about. You'll be okay if you halfway expect something. You'll be less blindsided by it, able to operate more efficiently within it, and that's our mission, to make sure everybody is able to do that. So thank you for your time today, Travis.
Yeah, man. I appreciate you, man. Stay with me a second, Scott. All right, guys, if you're out there investing in real estate, you know I wish you luck, and I hope you win.